Hi, I'm Jenny Brown. Welcome to our weekly buy-to-let market update. I hope you're all feeling as good as I am, having had a few days off from the homeschooling. My word, what a difference it makes not having to do that. I don't know about you, but I'm feeling super positive at the moment. We're hearing about the kids going back to school and life really starting to open up again. So that's really, it's so dreamy, isn't it? In terms of what we've seen in the last week, there have been some lender changes which I want to share with you today. First of all, we've seen the Cumberland make some changes to their lending policy for their holiday let mortgages. So first of all, what they're saying is that they're no longer going to be asking for 6 months worth of mortgage payments to be held on account. So this is quite unusual. Most lenders don't ask for this in the lending world. But what the Cumberland have been doing is saying, well, okay, if you want to have a mortgage with us, you have to hold 6 months worth of interest payments on account with us. So we've got that to fall back on if there are any problems, but they've removed that requirement for their holiday let mortgages, not for any of their other hospitality mortgages. They've also broadened their criteria to say that they will no longer require a debenture, so a charge essentially over limited companies if they're lending to a limited company. So again, lenders asking for a legal charge over the company which they're lending to. I think it's fair to say that was more common in the past, and the number of lenders who have made that requirement have diminished over time. So it's great to see the Cumberland align themselves with the market in that regard. And they've also said that they're going to be able to now consider properties of up to 3 units on one title as well, so essentially a small block of flats. Anything more than 4 units they can consider, but it would be on commercial terms. So great to see the Cumberland pioneering the way in terms of their holiday let requirements, obviously a big growth area, particularly for 2021. Now, we've also seen fleet mortgages reduce some rates, and these now start from 3.09%. And they're lending to limited companies and individuals. Now, look, fleet mortgages do need you to have an income of £15,000 per year. They will let you remortgage within 6 months of ownership, and they will accept HMOs of up to 6 bedrooms and multi-units of up to 10. The other thing fleet are really great at is lending to landlords with larger portfolios. Firstly, because they don't have a sort of cap, as it were, on the number of background properties, but also the rental calculation they use on the background portfolio is very good. Now, we've also seen Foundation Home Loans release 2 what they're calling green mortgage products, which are available for those properties which have been issued with an EPC grading of C or above within the last 12 months. And they're making these rates available to individuals and limited company borrowing. Now, with these products, you can remortgage within 6 months of ownership. So if you think about it, if you bought a property or you owned a property whereby the EPC was below a grade C, and then you did some works to renovate that property and bring it up to a C or above, and you then wanted to remortgage the property to pull out some of the capital that you put in to cover the cost of works in the first place, then this could be a really good solution for you. The rates are available, as I said, for the limited company and personal. Now, Foundation Home Loans don't have a minimum income requirement. They're very happy to lend to those landlords with larger portfolios in the background. So it's a really solid offering from these guys. The green mortgage thing is going to be something you're going to see more and more of this year as the industry really starts to consider, I guess, its impact on the environment, how it can kind of help drive the right behaviours. So we have seen in the residential space some lenders release products which are only available on properties with prescripted EPC ratings, and we expect to see the buy-to-let market go down that route. We have seen lenders who are offering reduced arrangement fees and favourable rates for products where there has been work where the property's EPC has been improved and the grading raised. Now, we've also seen some changes at West One in the last week. They're now accepting, they've increased their borrower exposure to £5 million. And they're also able to accept HMOs where they've increased the maximum number of bedrooms from 6 bedrooms to 10. So great to see them broadening their criteria. We've also seen the Furness reduce their 2-year fixed rates, and this includes on their regulated buy-to-let mortgage offering, with rates now starting at 2.69%. Now, a regulated buy-to-let mortgage would be a mortgage which fits into the category of or the territory of regulation by the FCA. So, buy-to-let mortgages, commercial mortgages, and investment bridging finance is not regulated by the FCA at the moment. I'm sure this will change in time, but right now they are not. Mortgages for your own home are classed as regulated mortgages. And when you're going to have a person living in the buy-to-let property who is a close family member, so for example, if you're buying a property which your son or daughter were going to live in, that would be classed as a consumer buy-to-let a regulated buy-to-let. And lenders really don't like these. Now, the reason they don't like them is largely because if we think about the premise under which buy-to-lets are underwritten, it's all about the rental income being able to support the mortgage interest payments and also giving us margin to cover for eventualities such as rental voids, maintenance, tax, all that kind of stuff. If you had a son or daughter or your mum or a family member living in the property and they were unable to pay their rental income, the reality is that you're quite unlikely to evict them. Probably what you're going to do is subsidise things yourself. And therefore, actually, it's not the rental income which is paying that mortgage, it's your own income. And buy-to-let mortgages are simply not really underwritten on an affordability basis. They're underwritten based on the rental income. So that's why lenders don't tend to like these regulated buy-to-lets. But great news that Finesse do. And actually, the fact that they've dropped their rates down, so they're starting from a very competitive pricing point, is really great to see. Now, just a couple of other quick updates. Skipton have reduced their 5-year fixed rates and these now start from 1.99%. Skipton will allow you to have up to 10 buy-to-let properties in the background. They do need you to have an income of £20,000 per year. They will allow you to have a mortgage up to your 85th birthday, and they only lend to individuals on fairly standard properties, but their pricing is very, very keen. And so for those landlords with 10 properties or less, particularly those who are looking to remortgage, I think the Skipton offering is incredibly solid. We've also seen Metro Bank reprice, and their rates now start at 2.24%. Now, again, with these guys, it's personal names only. You can have up to 10 properties in the background. They don't have a minimum income requirement, but you do need to have an income which is not derived from rental income to borrow with these guys. And again, they will lend on a mortgage where it matures before your 85th birthday. So a fair amount of change in the lender space this week for you. Okay, so in an interesting turn of events, you may recall that in the preceding few months, we've been reporting a reduction month on month in the price that houses are coming to market at. So in the run up to the new year, we saw the price that people were asking for properties as an average increasing, and the completed, so the prices actually paid, also going up. What we started to see in more recent months, so actually the 3 consecutive months to be precise, is the price of properties coming to market starting to come down again. But an interesting twist, and this is according to the latest Rightmove house price index, this number, so the value of properties coming to the market, has actually gone up by 0.5% in the last month. So what Rightmove have gone on to say is that its figures show that the number of new buyers is actually continuing to grow, despite it being probably too late for most people to now beat the stamp duty holiday deadline. Indeed, they've gone on to say that 1 in 5 buyers who agreed a purchase in July last year have still not completed more than 6 months later, which leaves an estimated 100,000 buyers still unlikely to complete within the stamp duty holiday deadline. And I think really what this just goes to show us is that actually, while people were kind of pushed to make decisions and expedite their decisions early on with the stamp duty holiday announcement, what we've clearly seen is prices start to come down, and new properties to the market also started to slow. People were really sort of thinking, well, I'll probably miss the stamp duty holiday deadline now, so I'll just kind of leave things. But actually, we are going into spring, house buying season. There's lots of positivity in terms of the news regarding COVID and how life's going to kind of, start to resume to a more normal feel. And I think that's really what's that doing, is people are saying, well, okay, I might miss the stamp duty holiday deadline, but actually I still want to move house. That hasn't changed, or I still want to buy an investment property. So now's the time to get on with that. And this really is underpinned by some figures from Rightmove, which saw their February visits were up 45% compared to February visits in 2020. And if you just remember that in February 2020, we hadn't really got into the thick of the COVID situation. So numbers have really spiked. So it looks like actually potentially the fears about the housing market tanking could well be not necessarily unfounded, but actually won't really come to fruition, which would be really great news. In terms of the latest of the stamp duty holiday, and is there going to be an extension or not, the latest kind of thoughts or rumours are that Rishi Sunak is currently mulling over a 6-week extension to the stamp duty holiday deadline. The Daily Telegraph has said that he is mulling through a limited extension through to mid-May, saying that a lot of people would be caught in the completion trap if the holiday were to end when it's due to. I think by extending it by a further 6 weeks, what are you actually doing? It will help, obviously, some people who are kind of caught in the timings of things. But actually, what it's going to do is just push another bunch of people to suddenly want to rush things through to try and get them through in time for the mid-May completion deadline instead of the end of March one. I think really at Mortgages for Business, what we would prefer to see is an arrangement whereby anyone who has, for example, exchanged contracts by a certain date will be eligible to take benefit from the stamp duty holiday. But the completion date does not have an end date, or it has to be by the end of, say, for example, August. And that really just means that we can see an ending date, this kind of constant panic and worry that people are experiencing can kind of come to a close. And also then the people who are mid-transaction at the moment can have some of the pressure taken off of them. I know when we're speaking to our clients, they are finding the whole thing really quite stressful because simply every part of the process is currently delayed. It's not just the mortgage applications, it's the legals, it's the searches, it's the ability to book a removal van at the moment. It goes across the whole line of events. So let's hope we see some positive news. Just to confirm, we're not expecting to hear anything firm on the stamp duty holiday deadline until the budget on the 3rd of March. Lastly, from me this week, the Mortgage Works has published 2 reports which are based on surveys on landlords. And I always find these so interesting. And I know I always say this, but because the information that they're sharing with us is giving us the thoughts and feelings about landlord sentiment, which is really, really important to us. It's very, very interesting to hear. So first of all, in their tenant demand report, 19% of respondents had reported a decrease in demand for rental properties. But the really positive news here is that the remaining respondents reported either no change, they weren't sure, or actually more positively, an increase in rental demand. So actually over 50% of people that responded to this survey have reported an increase in demand. Equally, the number of landlords reporting profit from their investments has also increased. So that's really positive news. The Mortgage Works have also published their rental income analysis report, which showed that 22% of respondents had seen an increase in rents in the last quarter, and 15% are also planning to increase their rents in the coming few months. Now, they also talked about the average rental yields by property type and went on to tell us that HMOs are currently running at 7% as an average across the whole of the UK. Multi-units are at 6.1%, and detached houses are the lowest yielding at 5.1%. Now, what they also do is publish the average rental yields based on region. And the highest yielding area is Yorkshire and the Humber at 6.4%, and Central London coming in at the lowest at 5.1%. That is everything from me this week. Thank you, as always, for taking the time to listen and watch us. Look, enjoy the rest of your half-term week for those people who have children. I'm sure you're enjoying the break from homeschooling just as much as I am. And guys, the end is in sight, particularly if you live in Scotland. Look after yourselves. Do give us a call if you need anything, 0345 345 6788. Obviously, our website is open 24 hours a day, mortgagesforbusiness.co.uk, and I will look forward to catching you next week. Take care of yourselves.